Okay, after the semester you will know what's the difference, but even at this moment just keep this in your mind. Liability is not expenses. Okay, when we talk about expenses, only when we talk about income statement. Is that easy? When we talk about balance sheet items, don't talk about expenses. Alright? Two major financial statements, they relate to each other, but they never mix up. They never mix up. Same thing, okay? When we talk about balance sheet, don't talk about expenses. When we talk about income statement, don't talk about liability. And loan amount is liability. Loan amount is not expenses. That is the reason why when we calculate net profit, we cannot deduct loan amount paid out. We cannot do it. Any confused right now? Any questions? Any input? Yes.
Earlier you talked about depreciation for the security, for example. You said depreciation is about 200,000, for example.
Yes.
What is that depreciation based on the improvements or based on?
Yes, very good question. We'll talk about depreciation later on, but right now, just tell you, depreciation only based on improvement. Land value never get depreciated. Okay, only the value on the improvement on the building or on your equipment. So the bottom line is land value never get depreciated. Land value just sitting there. So for example, in my case, you pay 1.5 million to get the office, including the building and the land, right? So 1.5, that's your basic original cost. And we divide it to two parts. And how to divide it, this is the principle, okay? We will not get into detail, but say for example, between the 1.5, let's say 1 million is the land value. Just give you one example. And $500,000 is on building. And only $500,000 could be depreciated. And the 1 million value on the land is always sitting there, just sitting there. Alright? Up until the day you sold the whole building, say in my case, total you sold 3 million, but for transaction fee you pay, say for example, 100,000, right? So you have 2.9 as we call amount reliance. This is amount reliance. That is a taxation terminology. Okay, it's defined by the IRS. So 2.9 is the amount reliance from this transaction. However, this is not your profit, right? 2.9 is revenue here. It's here. In order to come up with your net profit, you need to provide your total cost. And when I say total cost is 1.5 original cost plus $500,000 you put in later on for renovation. So that's 2, right? But during the year, you accumulate 200,000 depreciation from the building. So you have 2 million total, deduct by 200, so your cost right now is 1.8. So that's why your net profit from this transaction is 2.9 minus 1.8 is 1.1. And you cannot no more deduct loan amount payoff. If you do that, you commit a very common mistake. This is a very common mistake I've seen over and over again. And the reason why is people, they never learn accounting, they don't know loan amount should be under liability category. Loan amount you pay off, loan amount, even you pay off, you don't pay off as expense, you pay it off as loan liability. Not necessarily anything you pay off as expenses. Be careful, okay? So this is a very important concept for those of you, you're sitting here, you never learned accounting before. Very important message, okay? Not necessarily each dollar you pay off consider as expenses. Keep this in your mind. Very important. Not necessarily each dollar you pay off consider as expenses. Sometimes you pay off your dollar to relieve your liability. All right? So at least from today, you know one statement is called balance sheet. When we talk about balance sheet, owning assets, liability, and equity. A equal to L plus E. This is it. Don't confuse. Don't get involved revenue or expenses. Alright? And when we talk about, you want to close the door? Shut the door. And when we talk about income statement, only talk about revenue minus expenses. Do not confuse with assets, liability, or equity. Very clear cut. This is it. This is it. So far, okay, Peter.
Does the loan pay off the principal? So how about the loan interest pay?
Yes, okay. Loan interest, you don't pay off. When we say pay off the loan, we never say pay off loan interest. Usually, interest, you paid it out during the period already. We'll talk about that. And the loan interest, when you pay off loan interest, it is considered as expenses. So, in my case, okay, when you sold the property 2.9, in the meantime, you pay off your loan 1.4. So your net proceed only probably receive 1.5 cash in this case. But the 1.5 that's called net proceed. This is the money you receive, all right? But when you pay off this 1.4, usually we mean you pay off the loan outstanding principal at that moment. 1.4. That's your principal, outstanding principal. And you say, what about the interest? The interest you pay off already, usually down the road during the period. All right. But in the very special cases, probably you pay off 1.4 principal and on the top a little bit about unpaid interest in the meantime. Then you need to differentiate 1.4 payoff to relieve your liability, and you pay off certain amount unpaid interest in the same time, say 2,000, 3,000, 5,000. That considered as your expenses, and expenses will affect your net revenue or the net profit. So do I answer your questions, Peter? Okay. So usually when we pay off the loan, we only pay off the principal, outstanding principal. But no surprise, you may pay off a little bit unpaid interest in the meantime. But they are different. You pay off principal to relieve your liability. And liability will affect your balance sheet. If in the meantime you pay off a little bit unpaid interest, it will affect your net profit. So that's why I say it's very, very crucial, okay? Very important. From the beginning, the first class of this financial accounting, you need to know there are 5 categories. 5 categories. 3 affect your balance sheet. 2 affect your income statement. And they are not crossable. They are not crossing. You don't cross the ball. Always stay there. All right? Are we good so far? Can we move on? Yes.
Why you say 5 o'clock? It's just a 4.
Yeah, the 5 is here.
Oh, sorry.
Because I cannot go to the bottom. So move here. Sorry about that. Yes, this is a good question, because if you were sitting in front of the computer, not in the classroom, you may ask the computer, say, Professor Tong, where's number 5? Yeah, I cannot answer your questions. Then you send me the email. All right, so far so good, right? We can move on, right? As I say, okay, financial accounting is not that difficult. It could be very complicated, but it's not that difficult. Once you grasp, okay, once you can control the very basic idea, you go from the very basic idea to expand your application. Everything should be easier. But again, I know the tough point is you need to classify the item in the right box. As I said, loan amount principal is in the liability box. Interest you pay go to expenses box. However, if interest already incurred but you have not paid yet, it's called interest payable. You go to liability box. So, I'll give you more and more example. Even we talk about interest by itself. If you already pay it, due time you pay it, you go to expenses box. If interest incurred already, but you have not paid, you go to liability box. And the opposite is, if you prepay interest, the interest has not incurred yet, for some reason, I don't know, you just prepay, it becomes assets box. Okay, I just give you one example, I will give you the more detail. So, as I said, okay, when people sitting here, you learn your accounting, the most difficult point is, how can you classify this item into the right box? That is the most difficult part. If you done it wrong, then everything will be wrong. So say for example, the interest is very strange. How about rent? You just prepay the rent. You just prepay 6 months rent. When you move in, for any reason, I don't know, the landlord just require you to prepay 6 months. And you do it, so you prepay 6 months rent. When you move in, and the money you just pay, you will become your assets. Even though the cash you pay already, this cash does not become expenses because it's not due yet. You just prepay something in advance, and they prepay in advance become assets box. All right, I will give you more and more example. All right, so I think even in the real life, you will encounter, you will face the problem. You may sitting there and say, hey, this item I should enter into which box? Some situation is very simple and easy, but some situation may be very ambiguous, may be confused. And sometimes, guess what? Sometimes maybe allow you to do either way. Maybe, right? So that is called the very basic financial accounting principle. We'll talk about that. And the principle, some principle may change. Okay?
It would be nice if there was a list of accounts that actually.
I will give it to you. It's also in your book. I'll give it to you. As I promise you. Give me your email, please, okay? For each class, I promise you I'll give you my slide. Okay? As I say, I you know what? I tear off my book. When I receive my book, I cut it off, Why? Because I need to make my slide. And I don't make each copy, okay? I don't make each single page. I only select very important page. I will send you the email, okay? So before you get your book, at least you have something to learn.
I have a question.
Yeah, go ahead.
Like the real estate, for example.
Sure.
Let's say you bought for 1.5 million, then over the years you made, every year you did some improvements. So every year when you file a tax return, those improvements should be an expense. Then you deduct it from your tax. And the final, when you sell the building, you can accumulate all the improvements minus the depreciation and apply it to the sale again.
Yeah, no, the answer is not. So let me repeat his concern. Very good concern. Say, as the owner of real estate, every year we may put money in to improve it. But if every year we already deduct this money as expenses, how can we do it again by the time we sold it? The answer is we cannot do that. Okay. Why? Because for each money, each dollar we putting in on our real estate, at that moment, we must make a decision, follow out, the regulation. Okay. Each money we put into our real estate, at that moment or for that year, we need to make a decision. That dollar we put in, Either way, cannot be both. Either as a repair expenses or as an improvement. This is a key point. This is a key point. So as long as we differentiate this money we put in is expenses for repair, then we deduct it in the year. So once this dollar becomes expenses, you will not accumulate as improvement. So either way as expenses or become the cost. So again, this is a very important concept you take away from this class. The money we spend not necessarily become expenses. So if we treat it as a repair, it is expenses. If it is expenses, it will not become cost. So for the lay person, they don't have this idea. They always confuse, is expenses or is it cost? No, cost, sometimes for our daily language may be the same. When we use it as a daily language, cost expenses probably is not too much difference. But for accounting purposes, it is difference. All right? For accounting, for taxation, it's a major difference. Okay? When we say this dollar we spend as the expenses, we deduct that in the year already. It reduces our income already. But if we treat it as a cost, and the full name is called improvement cost, it becomes cost. And if it is cost, number one, we cannot deduct that in the year. Number two, we need to remember we accumulate this as a part of total cost. And only upon the time we dispose, we sold this property, then we deduct that and to reach a conclusion what is our net profit. So am I answering your questions?
Yes.
This is very important, okay? Expenses, cost, for daily language, we don't care about that. But when we talk about accounting, when we talk about taxation, it's difference. It's difference. Why? Because expenses go to expenses. Cost go to our assets. Cost go to our assets. So that's why I say it's so important from number one to number five. Number five, okay? So, good, right? So far so good. I would rather we go very slowly, okay? Maybe some of you may become CPA in the future, okay? This class is not designed for CPA, all right? But maybe give you inspiration, okay? Give you more interest. They say, hey, how about I try to become CPA? Well, it's not joking, you know, because few of my former students, they became a CPA. They never thought about that. Say, after they took the financial accounting, they say, accounting is not that bored. It's not that bored as I thought before, you know. So, you know, I would rather we go slowly, and give you the correct and very basic and very solid concept. Right? So far so good.
Another question, sir.
Yeah, go ahead.
How do you determine which method to start with? You say you have to, when you start business, when you determine which tax.
Well, for real life, okay, for real life, I will recommend my client, my student to start your business as a sole proprietorship and use a cash method. For everything we talk about here, you can apply it to cash method. Even though the book or for CPA exam, okay, for CPA exam, you're gonna base on accrue method. But everything we learn here, you can convert it as your sole proprietorship and cash method. Nothing wrong. But if you have any questions, you don't know how to convert it, we can talk about it. We can discuss, yes.
So sole proprietorship has no tax ID, right?
Okay, let me repeat Catherine's questions. Say, for example, we start our own business as a sole proprietorship. That's very normal, okay? And she said, let me change her questions a little bit. I think her question is, if we were running our sole proprietorship business, can we get a separate tax ID? The answer is yes, if you really want to. But if you don't want to bother it, keep it simple, you just use your social security number. That's fine. But for any other reason, you can apply EIN, employer ID number, and very easy, just online, you can get it right away.
EIN?
EIN, right, employer identification
Is it
number.
employer, employee identity?
Right, employee, right. But if you don't want to bother it, it's fine. But you want to, file the payroll tax for that kind of purposes, you better off run EIN. Don't use your Social Security. You're gonna miss out. Okay, too much. So far so good, right? Okay, let's see this. So for those of you who have not taken my entrepreneurship for next semester, this is a very good starting point, right? Nothing wrong. Because we can talk about a lot of things, say business type, how to choose the method, that kind of thing. Retained earning, we may not have too much time to talk about this, but here is the formula, okay? Say for example, your business is ongoing, all right? After the first year, okay? By the way, this is one thing we will not talk about that, okay? This is called a tax calendar or tax year, okay? Because that is more suitable to talk about that for my in my entrepreneurship class or business law. But in your mind, for each business cycle, there are 12 months. There are 12 months, but not necessary end by the end of the year. You can choose any other day as your final day. But for small business, we just follow the calendar. It's called calendar year. So the last day of your business is December 31st. But for more complicated business, you can choose any other day, any other last day of the month. Let me put it this way. But I just assume for small business, will follow our calendar day. All right. So once our business year close, then we also need to close our accounting book. We need to close out. All right. One thing we are going to do that is called income statement. Then we need to calculate for the whole year. Eventually, if you follow your monthly statement, the job should be very easy. Usually we close the monthly book. For every month, we close our book one time. When we say close the book, mean you calculate your monthly sales minus monthly expenses, and you receive the monthly net profit for your business. So if you do this every month, and by the end of the December 31st, it should be very easy, right? And then, for example, for the whole year, you have a total 1 million sales and total, say, 500,000 expenses. You see your annual net profit is 500,000, easy, right? So this 500,000 is called earning. It's called earning, all right? And for your sole proprietorship, you don't need to make any decision. It does not like a corporation. For corporation, you need to have the board meeting, you need to have a shareholder meeting to approve it. But for your own business, you just made a decision. This 500,000 is stay in the business account, or you withdraw portion, right? If everything stay there, return earning. It's called return earning. So for the return earning statement, basically is every year you do this again. So the formula is the amount from the last year. It's called beginning of this year, right? Plus or minus return earning for this year. And then minus if you have any dividend you want to distribute to your shareholder, right? And then become the balance for this year. And the balance of this year become the beginning for next year. We may not spend too much time for this, okay? Because assuming for small business, return earning statement is not that big deal. This is for public company. Right. Any questions so far?
for fiscal year, you said it usually it's calendar year for small business. But if I decide to say I don't want to do, I want to use for somehow.
Yes, you can choose your.
Do I have to declare or I can?
Yes, very good questions. How can you declare your tax year or your fiscal year? How can you do it? Okay, the way to select your fiscal years usually is your first tax return. Of course, when you start out your own business, you can write a memo. So it's especially for your sole proprietorship. Okay, you just write a memo. Say, oh, I choose for any reason you want to choose February 28th or the last day of February. All right, and then to do it formally is the first time you file tax return. And on the top of your tax return, it will ask you what is the last day of your fiscal year. So once you choose it, you cannot change it. You need to follow up. If you want to change your fiscal year down the road, you need to get a special approval from IRS, and it's very hassle. I don't recommend to change it. You just follow it. So this is the reason why I say for small business, just follow up calendar year. It is not for this class, but if you really want to do it, if you really want to do the research, another topic for your final project is for the tax year, or say fiscal year, and there's a guideline. There's no limitation for sole proprietorship, but there's a regulation for partnership. Since partnership is not that popular in our class, unless you have your special situation, you are running your business based on partnership, then you do it. Otherwise, we will not spend too much time on it. It's very complicated. All right. Okay. By the way, I just want to spend 1 more minute for the retained earning. Okay, retained earning is big issue for C corporation. For sole proprietorship, for S corporation, for the limited partnership, you can do whatever you want. The reason why is if you're running your business as a sole proprietorship or S corporation or the partnership or LLC, limited liability company, those type of organization, they don't pay income tax. Those organizations, their annual net income all fall through to the owner. So return earning is not big deal for this time organization because it's only one level, one tier income tax. It's good and bad. It's not necessarily good. Okay, let me tell you. Okay, say for example, you're running your business as LLC with somebody else, and the business earn a lot of money, but for any reason you don't want to get the dividend. You just don't want to withdraw the profit from the LLC. This is fine, because LLC by itself does not pay income tax, so IRS doesn't care. You pay as a member, as an owner, you pay it. The problem is how can you pay it? Because if the profit is always retained by the LLC, and every year you need to pay LLC income tax all of from your pocket. So if you don't have a cash flow problem, you go ahead and do it. But if you really rely on the cash flow from the LLC operation, it may become the problem. Okay? So return earning, if it is under the LLC, partnership, S corporation, sole proprietorship, nobody cares. But return earning becomes the major issue retained by C corporation. Why? Because C corporation subject to double income tax. Corporation by itself pay one time. So after corporation income tax, it become net return earning there. When we talk about return earning from C corporation, they really mean after C corporation income tax. That's net. However, for some public company, for some reason, they say our shareholder voted. They don't want to pay double tax. Because if we distribute dividend to them, they will pay their personal income tax again. So our shareholder vote by majority say we want to hold return earning by the company to save their personal income tax. And the IRS will come and say, no, you cannot do it. Because C corporation by the nature is subject to double income tax. So if return earning accumulate by too much for no legitimate reason, and the IRS will come in to force C corporation to distribute return earning. So it is not big issue here, but I just want to give you the idea. So if your business is running based on C corporation, you may not be able to hold return earning forever without legitimate good legal reason. Okay, just keep this in mind. And the last one is cash flow statement. We may not have time to, for this semester, we may not have time to deal with the cash flow statement. It's very complicated. Eventually, if you want to do the research, it's a very good final project topic. It's very complicated. We all know cash is one item, one account under the assets. Eventually, cash may be the most important assets, maybe. Okay, let me put it this way. Cash is also almost everything. Alright? But cash management recently become a very major, big issue. Once in a while, we read newspaper or magazine. Right? Say Apple computer, they are holding, I don't know, hundreds billions dollar cash in their account. And supposedly they may use this cash to do the more investment, right? And you know, for this kind of company, one major important division in this company is called merge company, merge division, or say acquisition division. They just try to target, okay, certain company they want to merge, they want to buy out, because they have so much cash in their hand. They use this cash. They don't use cash just in the bank, right? No any sense, just put cash in the bank. They want to use this cash, and of course, after they pay off their account payable, their salary, their tax, still so much cash left over, right? And those companies use cash to merge, to acquire the target. Okay. So cash flow information is very important. They want to forecast how much cash on certain day they can control, they can use, and they can allocate. So there are three major categories. Okay, the major three areas to see. One is cash flow from operating. Operating means purchase, sale, employment. That's called operating. And second one, cash flow involve investment. Say for example, acquire, right? There's one chapter where I talk about investment. A company investment on B. There are three major different types. You can just go ahead, just purchase stock, and next day you sell it, or you can control it, or you can merge it. Okay, so that's called investment. And number three is called financing, right? You lease your office. That's financing. Okay, for lease. Okay, by the way, lease agreement by itself could be operating. It's just regular daily operating, but lease agreement sometimes become the financing. Say for example, you have a truck. Your company need to buy a fleet of trucks, right? You don't pay cash, and you lease. Even though this is a lease, but eventually it is financing, right? So when we talk about lease, could be operating or could be financing. But again, for this semester, we may not have time to do too much on the cash flow statement. We may not. But if you want to do more research and use this as your final project, pretty much welcome. A lot of topic you can do it. Okay, this is the relationship between those two. Between those two. Okay, the number one, always do your income statement first. Okay, after you calculate your income statement, then you know for the whole year whether or not your company make money or lose money. Hopefully, you make money. All right. But for Silicon Valley, that is not the case. Okay, for Silicon Valley, usually the company go IPO even without any sales. Alright, so we just talk about the regular small business. Okay, hopefully, we are running our business at least break even. Hopefully, we make profit. So you have we have 3,000 net income here, and that one will go to the return earning. Say beginning we have another 6 something plus this year minus dividend we have. So the number one we have income statement to see whether or not we have earning. Then we move the earning to the return earning statement. Then we go to the balance sheet. Okay, return earning will affect our E account, equity account. Okay, so this is how we relate from the return earning to balance sheet. Then we have the cash flow, the cash number also reflect the same amount, the same balance on our assets. Alright, so this is how four statements relate to each other. Okay, this is your homework. Okay, GAAP. On your book, page 19. So every time when people talk about GAAP, you know what they're talking about. Okay, General Accepted Accounting Principle, GAAP, and this is the standard. This is the current standard accepted by SEC. So GAAP is a very standard accounting principle for those public company to prepare their financial statement. All right, and one of your homework, you have two questions for the day. Okay, due in 2 weeks. The first questions I ask you is what GAAP is. What GAAP is. This is simple, very easy, right? However, I will not let you go that easily, right? So I will ask you, you need to do the research because SEC is going to abandon GAAP. It's going to abandon. Eventually, this movement has been for years. Why? Because GAAP is a standard adopted in the United States. However, throughout the whole world, not too many countries use GAAP in order to communicate with another foreign company. And SEC agreed by the year, I believe, 2016. I may be wrong. Okay, few years down the road, SEC is going to adopt the more popular international standard. It's called international standard. I will provide you the very little information there, and you tell me what is the problem with GAAP and what is the major reason SEC considering abandon GAAP and adopt more popular international standard. And you whatever you want, you can just give me 1 page, your answer. And the whole reason why I want to bring you this attention is, you know, at least from this class, you know, GAAP is the current standard, but it's phasing out. It's phasing out. So for your final project, you may also select a topic, say, what is the good or bad to adopt or to abandon GAAP. And same thing, you can talk about what's good or bad for the new international standard and your idea, right?
So the 2 homework questions is what is GAAP?
No,
and why
only
do
one.
we
This
abandon?
is only, excuse me, this is only consider one. So
Okay.
in the number 1, I will ask you what is GAAP, and I will tell you why SEC moved from GAAP to international standard.
Okay.
And if you want to tell me more, say good or bad, it's fine, but not more than 1 page, okay? Just give me 1 page. And the second questions I will give to you later on.
Okay, are you
Yes.
going to post that on your
Oh yes, I will email to you. In case you did not receive my email, where's my sign sheet right now? Where is it? I want to make sure everybody. This is for school. How about mine?
Both of them are there.
The thing on the
Yeah, both.
Yeah, post
They're
that.
both in there.
Yes.
above, and get my sign sheet to me. I want to make sure I can read your email. Okay, so in case you did not receive my email by tomorrow afternoon, send me the email. Okay? Because I know once in a while, every semester I want to misread it. During 2 weeks is reasonable, right? I know this is not your own class. I know that. I fully understand, so I will not give you too much. But still, as a teacher, I know if I don't give you the homework, you don't learn. I just know that. Okay, I was a student before, so that's my responsibility eventually to at least help you to learn something from this class. So give the page to me. Okay, for chapter 2, we have a few examples where you need to do it. And chapter 2 will focus on the balance sheet, okay? So again, everybody, what are our balance sheet, please?
Asset,
Assets,
liability,
liability,
equity.
equity, okay? Don't add, okay? Don't deduct, don't add, okay? This is it, okay? Assets equal to liability plus equity. No more, no less, okay? This is it.
Professor?
Yes.
So, let's say that, let's assume that Singapore and Hong Kong use a different international standard.
Alright.
And assuming that Apple has a branch over in Singapore.
Okay.
And I know it's a popular topic now, but
Right.
I don't want to go to Apple's tax issue. So maybe a big company like Apple can use two standards of accounting
Yeah,
principle now.
let me answer your question. This is a very good question. For those international company and the headquarters is in the United States, especially their stock listed in the New York Exchange, right? How will they do it? Right? This is a very common questions, I believe. Right? This must be very common. The way they do it is they must follow a GAAP for sure because they need to report to SEC. However, for each local offices, they need to follow the local. So I assuming for those big companies they have followed two standard. And the result may be different a little bit. The final result may be different, but it's okay. It's allowable. It's permissible. Okay, it's fine. But again, even though we're gonna change it from GAAP to international standard very soon, but this is still the same. Assets equal to liability plus equity. It's always the same. You will not change. Okay. Different principle may affect the characteristics. It may affect characteristics. For example, as I said, if you enter into the lease agreement, you want to enter into as a liability or enter into as expenses, it may difference. Okay? Why? For small business, you would rather trade each money you spend as expenses as much as you can. Understand? Let me repeat it, okay? For small business, you would rather trade each money you spend as expenses as early as possible. Why? Because you can report as expenses and deduct your net profit. You reduce your net profit, then you reduce your tax. If you treat it as equipment subject number 1, headache, depreciation, you need to hire more people coming to do the more bookkeeping, and then you can deduct the full amount in the same year, right? So, but you know, as I say, different standard may change the characteristics. It may change that, but assets equal to liability plus equity, always the same. Don't worry about it. Right. Okay, we'll see a few examples here. Yeah, we still have time to do it. Element here, as I said, is okay. This one is page number 51. So for this company, it's more complicated. Okay, you can see under the assets, you will see current assets. You will see different from current assets, different from investment, different from property, equipment, and different from note receivable, intangible, as Maria just mentioned. So right now we learn another terminology, current. Current assets usually mean this kind of assets could be easily converted into the cash. So cash is cash, no problem. Account receivable usually mean within 30 days. So you see account receivable is different from note receivable. You see here? Note receivable mean you lend money to somebody else and it is you cannot get it back within 30 days. So everything listed here is either cash or something else. It should be very easily converted to as cash. So cash, account receivable, supplies. So can you give me an example for your business? What kind of things supplies? What kind of things supplies? Computer maybe like computer. Okay. Sometimes we have a problem to differentiate from equipment to supplies. So yeah, maybe you can consider computer as a surprise. Nothing wrong. But I just want to give you one idea. How can you classify an item to become a surprise and not equipment? How? Anything you can report it as expenses. You can report it as not subject to depreciation. Let me put it this way, like printing paper, okay, copy paper, toner, ink, that kind of thing. You can just report this as expenses and write it out right away, and no headache to struggle with depreciation. And you report as a surprise. So before you use it, it's an assets, okay, like a printing paper. But once you use it, you reduce surprise. So you reduce from the assets and become expenses. So directly from assets to become expenses, we say this is surprise. Right? Prepaid, see? Prepaid expenses. Everything you prepay in advance is assets. And regarding liability, we also have a current one. Everything you must pay within 30 days. You must pay within 30 days.
I have a question.
Go ahead.
Let's say for example, if I'm trying to manufacture something, I bought the different parts, and by end of the year I may not finish, or end of the month I still have those parts not assembled as a sellable product. Can I count those as a surprise?
No, very good, important. You see, okay, let me repeat his questions, okay? Let me repeat it. He said, assuming your business is a manufacturing. So during the regular business days, I purchase parts coming in, right? Then during the year, I put some of them together. But by the end of the year, they are not resellable yet. We call semi-final product. It's not final, semi-final product. All right. So can you report this as expenses? The answer is no, because unless by law your inventory become obsolete, say no value, for any reason the market no more demand, or technology change, or the version change, Unless you can prove this inventory totally become obsolete, you cannot report. Still, it is inventory. You can see under the total current assets, underneath it is inventory. You see? So inventory is assets, is resellable, but not necessarily you can convert it as cash within 30 days. So unless your inventory, you can report it as obsolete, and you can move from assets to become expenses, otherwise it's always there. You know what? You know what? This is a big issue for your final project. Inventory is big issue because different principle, different treatment. Some of the company give you very beautiful